Hi, this is David Dickens, and today we're going to tackle a question about the ins and outs of selling an inherited home. This situation in particular was complicated because multiple heirs are involved. So hopefully there's something in here for you. I'll go get Walter, and we'll get started.
Back on another edition of Cover Your Assets KC. Walter Stroholtz here alongside David Dickens, the President Wealth Advisor at Creative One Advisors Group. Follow us online at creativeoneadvisorsgroup.com. David, great to chat with you once again this week, my friend. I know that you're hurting a little bit because it's Super Bowl weekend coming up and your Chiefs aren't in it this year.
That is very true. But and I think I mentioned on a prior podcast, I really wasn't all that interested in what was going on. But yeah. I watched basically every minute of the playoff games. They were super entertaining. So, no Chiefs, okay. Maybe we're just taking a year off, we can hope.
That's right.
These were great games. So I'm kind of, looking forward to the Super Bowl. Should be fun.
And two teams that we definitely probably didn't pick. I don't know many people that would have picked them at the beginning of the year as their two to be matched up. And Drake May, young quarterback, versus Sam Darnold, journeyman. I mean, it's got a lot of good storylines, so that'll be fun even if the Chiefs aren't in it this year.
And kind of the same thing about the college football playoffs.
That's right. Yeah.
I mean, the final game, you're
Indiana
like,
story.
Oh my gosh, who knew?
And that quarterback and that great run he had. I mean, that was just like Disney movie script. You couldn't have written it any better for that guy.
You couldn't. So that'll be fun to watch him as he moves on to the next level and see if Indiana can pull it together again 2 years in a row.
Yeah, I'll be interested to see if that's sustained success or if another team will follow that model and then they start to experience that success. It'll be interesting. My Tar Heels have put quite a bit of money into old Bill Belichick and trying to do. I think they were trying to do what Indiana just did with Bill. So maybe in year two they'll turn it around a little bit. Year one didn't look so great. So
as much as the turnover in that business, in the rosters has changed because of NIL.
Insane. Yeah,
all that came about when Belichick was working with pro athletes. So it'll be interesting to see if he can get into the rhythm of working NIL money and these changing rosters. It's be tricky to build a culture when you got people in and out for $1 million or $2 to go play someplace else.
It's going to be pretty tough, I think, for anyone to have sustained success given that landscape, but we'll see. I'm skeptically optimistic, if that's a thing. That's my approach on it, so we'll see.
At some point, they have to rein it in with some rules. But
got to put some guardrails up, you would think, but right now it's kind of the Wild West. So.
It is very much so.
Well, I don't know how we're going to transition all that into our listener question today, but we do have one, and you teased us a little bit with it, David. We're talking about selling an inherited home and the tax fears that kind of surround that, or complications at least, that folks maybe have some trouble with navigating. So I think this will be a fantastic little topic to dive into today, and something that maybe impacts a handful of our listeners either right now or something they'll face in the future, perhaps.
I hope so. We just get so many questions about inherited money. This is just another example. But most people come in with a fear of what they've just inherited. And in most cases, it's just not a big deal from a tax standpoint. So we'll dig into this and see what we can unpack for people.
Well, here is the listener question. Mom died 2 years ago, and my 3 sisters and I inherited her house. I've always wanted to sell it. They're just now coming around to the idea. But now they're worried about the tax implications. I keep telling them that I don't think it'll really hurt us from a tax perspective, but I can't really explain why. Can you help me out?
The answer is absolutely we can help you out.
Well, let's start with talking about the cost basis when someone inherits a property, because that's what a lot of this boils down to. People think they're going to have to pay on this all of the dollars of the sale of a home, and it's going to create this huge tax bill, but there's this thing called tax basis we have to be aware of.
Exactly. So I just created a real simple little example that I thought we would play off of for this podcast. Let's just say that Mom bought this house in 1990 for the nice round dollar sum of $200,000. And evidently she died in 2024. And I'm making up a number here, but let's just say that $200,000 house was valued at $600,000 when she died. So that was what, 34 years that she lived in that house, kept pretty good care of it, good roofs and gutters, and so now all of a sudden it's worth $600,000. And so what our what our questioner is, I assume, trying to figure out is, let's see, 4 heirs, gain of $400,000. If mom had gifted that to you girls, you women, before she died, then each of you would have a taxable gain to pay taxes on of $100,000 each. But she didn't. Based on everything we know here, she just died and she was the only owner, and somehow or other she was smart enough to have a beneficiary designation on the title for that home so that you gals didn't have to take this home through probate. You just inherited it. And so that's some super good news. So on her date of death, we believe that the home was worth $600,000. And that's kind of where the tax discussion begins.
That's where it all starts. All right. So how much capital gains tax might actually be owed in these situations? And also, just sort of as a side B of that one, in this particular case, the listener's saying, hey, 2 years have passed since they inherited the home. So if you wait a while, does that have an impact?
Exactly. It sure does. So if these gals had sold it, nothing we say today is tax advice for anybody listening. I'm convinced that the information we're going to give you is correct, but you should go to your tax advisor for the final word on all of this. So there was a $400,000 gain, but when mom died and you girls inherited this house, the gain for tax purposes gets wiped away. And your cost basis in this house is now not the $200,000 she paid for it, but the $600,000 that it's worth on her date of death. So if you had turned around, let's just say a month later, you could have pretty easily convinced the IRS that it was worth $600,000 when she died, and it was worth, well, let's just say you sold it for $600,000. There wouldn't be a taxable gain at all. You would each get your $150,000 proceeds minus any costs that it took to sell the place. And that would be $150,000 that you just inherit with no tax involved. I'm assuming there's no estate tax here. We don't know anything about the size of mom's estate. But from a federal tax standpoint, you wouldn't have owned anything on that $400,000 increase in the house while she lived there. But that's not what you said happened. What you said happened is you were ready to go, but your 3 sisters were like, well, I don't know, maybe we should take it. And there are really, I've heard a lot of discussions about why particular siblings didn't want to do something. And you had to have all 4 to agree to this because you're each a 4th owning and you can't sell 3/4 of a house to anybody. But there's some emotional attachment. There's maybe some inertia. Maybe somebody was having some other things going on in their life and they couldn't come to the decision. But now, in 2026, you've just had a realtor come out and they go, good news, ladies. This house is now worth $680,000. So if you can sell it for $680,000, you are going to have an $80,000 taxable gain. You inherited it at $600,000, you sold it for $680,000, and that $80,000 difference is taxable to each of you. You've held it for more than a year, so it would be a long-term capital gain of $20,000 for each sister, assuming you're all 1/4 beneficiaries, and I think that's a reasonable assumption. So when you get around to filing your taxes, one of the things your CPA is going to ask is, did you by chance get an appraisal in 2024? Because somehow or other, we're going to have to document that the house was worth $600,000 when you inherited it. IRS is going to need some sort of credible documentation, and it doesn't necessarily have to be, I don't think, an appraisal, but you'd have to go back and do some sort of fair market value, look at houses similar that were sold in that neighborhood, and you could come up with a valuation of $600,000. But the long and the short of it is, the amount that it has increased in value since your mother's date of death, that's a taxable gain, depending on how long you've held it, shorter than 1 year or longer than 1 year. It's either a short-term capital gain, which is taxed just like a paycheck, ordinary income, or long-term capital gains, which are taxed advantageously. One thing you might question, Walter, is, well, how advantageously is that taxed?
Yeah. It's not a black or white. It's kind of a sliding scale sort of thing.
It is a sliding scale. So I happen to have some of that information in front of me. If one of these gals is single, and maybe she's already retired, If she has taxable income of less than $49,451 in 2026, then her long-term capital gain rate is 0, because that means it's roughly associated with being in the 10 or 12% tax bracket. If one of these gals is retired and she and her husband jointly have a taxable income that is less than $98,901, then their long-term capital gain rate is 0. And that amount is indexed to inflation. So if you shuffle your feet and wait around to 2027, well, the numbers will be slightly different than that. If your income is above that, and I don't want to get down deep into the weeds on this, but if your income is higher than that, then you're either going to pay a long-term capital gain rate of 15% or 20%, loosely speaking. So it is a taxable gain if you waited. Now, if she's in a poor neighborhood or it got run down over the last 2 years, nobody went in, the pipes froze or who knows what, well, you could have a taxable loss as well. If you're claiming a taxable loss, that's really when the IRS is going to want to know, can you document the value in 2024 when mom died? So it can get a little twisty, but the good news for everybody involved is the big gain, the biggest part of this gain that happened from 1990 to 2024 isn't taxable to anybody. You take advantage of the stepped up cost basis. And what you're really concerned about is what has happened to the market value since you've owned it. In other words, mom's date of death.
Okay, very good. It's a great breakdown on some of those kind of complications that can arise and maybe some opportunities as well. It sounds to me this is a situation where, hey, 4 siblings, right, are sharing this burden. So I'm thinking multiple heirs complicate the tax picture versus just one person, but is that a wrong assumption?
It more complicates the decisioning process and not necessarily the tax picture. There's some extra calculation involved. If somebody got, 40% and the other people got 20% each, or some weird. But typically,
you get a bedroom, you get the kitchen and living room. That might make it a little more difficult if square footage ownership is not equal at that point.
Typically, the percentage ownership, the percentage inheritance is equal amongst the heirs. So
if you had a diabolical mother who just really wanted to mess with you and complicate your sibling cohesiveness, and
I'm sure they're out there,
right?
It's not complicated. In my opinion, it's not a complicated tax picture. Now, any one of these heirs might have it more complicated based on their personal tax picture. Maybe they're a very high income family and they're going to pay 20% long-term capital gains. Maybe they're in these 10 and 12% tax brackets, which I mentioned earlier, and maybe they're paying 0% taxes. But it's not particularly calculated. The tax picture isn't particularly complicated because there are multiple heirs. It's the decisioning process that becomes complicated.
Makes a lot of sense. All right, last but not least, you kind of hinted at this a little bit when talking about multiple heirs and making decisions. Since we're on this discussion of inheriting a home, we've covered the tax issues well, but what about the non-tax issues that families should talk through before selling or deciding to maybe keep a home?
There's always who's going to maintain this? Maybe 3 of the sisters live in far-flung places, but one of the sisters lives in the same town that mom did. So my guess is that sister is going to carry the weight of making sure that the pipes don't freeze, that you don't get squirrels in the attic. Think of all the stuff that you go through as a homeowner. Well, once the home is vacant, somebody has to keep track of that. 1 or 2 of the daughters may have an emotional attachment to the home, and that's caused them to delay in selling it. Another thing that I thought about, that I've seen this actually in practice, is the property might actually go to serve one of the daughters' long-term retirement goals. So, for instance, let's say that mom owned a cottage or a relatively small home in Palm Springs or Scottsdale or Napa. Well, one of the gals might say, well, heck, I want to keep that as a rental property. Then it becomes complicated because she has to figure out an equitable way to buy her sisters out of this property. And then she takes sole ownership. But that may indeed further her long-term retirement goals. Maybe one of them wants to keep it because it's in their favorite place in Scottsdale and they just want to go there in the winters. So that can be really complicated. Nothing that can't be settled. I can't think of a reason why one of the sisters would say, well, I'll sell it for $680,000 to somebody I don't know. But if Cindy Lou wants it, well, it's going to be $720,000 because I never liked that Cindy Lou anyway. So, with family issues, gosh, you don't have to be in this business very long to see that some families are somewhat dysfunctional, especially as it relates to money. So this is just one thing where hopefully everybody gets around the table or on a Zoom call, figures out what their intentions are, and then they just move forward with probably a third-party sale, get the money in hand, and move on down the road, each of them paying the taxes, if any, that are owed by them based on their personal tax situation.
Great breakdown of all of this, David. Any final thoughts on the inheritance and selling a home, or final comments for our specific question asker here?
I can't really think of one other than this is so similar to other properties that you might inherit from a parent, whether that is a piece of raw land or whether it's a bunch of stock or some bonds or any type of real financial asset. The stepped up cost basis has been around for a long time. I couldn't really tell you when that came into the tax law, but it's been a long time. And they occasionally talk about getting rid of it. But honestly, Congress is really good at putting in temporary changes and then just making them permanent. And this, while they talk about it a lot, it's likely to hang around for the rest of my lifetime and probably, Walter, the rest of your time. So the stepped up cost basis is probably a fixture for the future. It is a significant benefit when you inherit property, whether it's a home or a big old stock portfolio. So when you do lose a loved one and you inherit, make sure you get some good advice and make some good decisions that the one who left this stuff behind would feel good about.
Excellent. And really appreciate you tackling that question for us today. If you've got any questions for David, it's easy to reach out and dive into things one-on-one with the team. All you have to do is call 913-317-1414, 913-317-1414, or go online to creativeoneadvisorsgroup.com, creativeoneadvisorsgroup.com. We've got contact information listed in the description of today's show, so reference it there if you need it. And don't hesitate to reach out if you have any questions, want to go through the complete planning review process. You can certainly do that with David and the team at Creative One Advisors Group as well. You'll tackle things like these kinds of questions, and so much more related to financial and retirement planning, so don't hesitate to reach out. Thanks again for the breakdown, David. Hope you have a great rest of your week, and we'll be talking to you again soon.
Talk to you in a couple of weeks.
All right, sounds good. We'll see everybody again next time right back here on Cover Your Assets, KC.
Creative One Advisors Group has been proudly serving families in the Kansas City metropolitan area since 2003. Over the years, we've evolved to help meet the needs of our clients, becoming KC Financial Advisors in 2010. In November 2021, our advisory business was acquired by Creative One Wealth, LLC, C1W, and in January 2025, we officially adopted the name Creative One Advisors Group. Previous episodes were recorded under the branding of KC Financial Advisors, which has since been rebranded as Creative One Advisors Group. Any references to KC Financial Advisors should now be understood as referring to Creative One Advisors Group. Investment advisory services are offered through Creative One Wealth, LLC, a registered investment advisor. Creative One Advisors Group is a DBA of Creative One Wealth. Insurance services are offered through licensed insurance professionals. Investment advisory services are provided in accordance with the fiduciary duty of care and loyalty that includes putting your interest first and disclosing conflicts. Insurance services have a best interest standard, which requires recommendations to be in your best interest. Creative One Wealth is not affiliated with or endorsed by any government agency and does not provide tax, legal, or estate planning advice or services. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss. Neither asset allocation nor diversification can ensure a profit or guarantee against losses. None of the information contained herein shall constitute an offer to sell or solicit any offer to buy a security or any insurance product. Insurance product guarantees are backed by the financial strength and claims paying ability of the issuing company. The Creative One family of companies includes Creative One Wealth, LLC, a registered investment advisor, Creative One Securities, LLC, member FINRA SIPC, and a registered investment advisor, and Creative One Marketing, LLC. These companies share common ownership. Additional details regarding advisory services are available in our firm's ADV Part 2A and Form CRS.